In this video, I'm going to talk about the ledger. This video will bring together lessons 6 and 7. In lesson 7, we talked about a journal, which is where you first record transactions, and you would use debits and credits to record the transactions. And this is part of the journal that we did. This is what it looks like. You have the date, you have the account name here, and then the amount would go in the debit and credit column. And then if you wanted an explanation, you would put that underneath. And the post reference would be the account numbers from the chart of accounts. And then we also, in lesson 6, talked about the ledger, and I actually did it backwards. I did the ledger first and the journal second in the video sequence. And that's just because it's easier to learn debits and credits when you have the visual of the T accounts. And T accounts are an informal ledger. You would copy any debits and credits from the journal over to the ledger. Debits and credits represent increases and decreases to the accounts. Debit's always going to be on the left, credit is always on the right. And these are the debit and credit rules that I talked about. For assets, draws, and expenses, you add to those with debits, subtract with credits. For liabilities, equity, and revenue, you would add with credits, subtract with debits. And then just to bring together lesson 6 and 7, I want to go over 2 examples that I did. This was actually the exact same situation that I had in both lessons. The owner invested $5,000 in the business and deposited to checking. The checking account is an asset. We would be adding to checking, adding to an asset. That would be a debit according to the rules. And then we would also be adding to the owner's equity, which represents the owner's investment in the business. When you add to equity, that would be a credit. So debit, checking, credit, equity. And that's what this entry was showing. And then that same exact entry was in lesson 6 in T account format. The owner invests $5,000 in the business. Again, it's still debit, checking, credit, equity for the exact same reasons. And this is what it would look like in the T accounts. In this video, instead of doing the T accounts, I wanted to show you how it would look in a more formal looking ledger. A formal ledger will have a little more information than the T accounts. It would have the date of each transaction. If there was a beginning balance, that would be in here. In this case, there's a 0 beginning balance on this line. It has a journal reference. Journal reference is just J for journal, and then the page number from the journal. And then it would have a debit and credit column for the transaction itself, and then a running balance. This is what we're going to do today. What I'm going to do in this video is go back to lesson 7 and go through these journal entries. I've already talked about what you're debiting, what you're crediting, whether it's an increase or decrease, so I'm not going to do that again. All we're going to do in this video is take these journal entries, which this is on my website. I'm going to take these journal entries and I'm going to show you how to post them to a more formal ledger, like the one I just showed you. This spreadsheet is on my website. There's a blank ledger that I'm going to use today. There is a beginning balance of 0 in some of the accounts, and you'll learn later why some of them have a beginning balance and some of them don't. Some of them get closed out after year end, and we'll discuss that in another lesson. At this point, there's 0 beginning balances, and I'm just going to show you how to post. And then I also have the answers in here, so you can practice this on your own several times. I have a blank trial balance. A trial balance is a list of accounts and their ending balances. This is just going to help you make sure total debits equal total credits. And then of course I have the answer key also. You can see in the ledger I have a section for each account. Here's checking, Here's accounts receivable, office supplies, and so on. So you would just look at the journal entry, look at what accounts are affected, then find them over here in the ledger and put in the entries. The first transaction was a debit to checking and a credit to owner's equity for $5,000. So here's checking. I would just put the date. I don't need to write June again because we're just assuming it's in chronological order. The month is the same. We're just going to June 2nd from June 1st. I don't need to put a description because there's a description over here in the journal. And then the journal reference. Now, all of these journal entries are on page 1. So all of these journal references are going to be J1. The first debit and credit columns are going to be for the transaction itself. And this was a $5,000 debit to checking. So I would just put $5,000 here. And then the balance, the running balance is over here. All we have at this point is a $5,000 debit. So the balance would also be a $5,000 debit. And that's it. You don't have to rethink the debits and credits because you did that over here when you created the journal entry. It is just simply copying over from the journal to the ledger. So now let's find owner's equity. Here's owner's equity. We would put a 2 for June 2nd. Journal reference would be J1. It's a $5,000 credit. And since there are no other balances or transactions, the running balance is also a $5,000 credit. And that's it. Okay, the second entry was a debit to rent expense, credit to checking for $750. So here is rent expense. It didn't have a beginning balance or anything on the first line, so I'm just going to go directly into putting the transaction here. The journal reference is J1. The transaction was a $750 debit to rent expense, and at this point that would also be the balance. And then let's go back up to checking. There was a credit of $750 to checking. So I put the date, the journal reference, and $750 as a credit. Now for the running balance, we had $5,000 as the debit balance before, and then a credit is going to subtract from a debit. When you have debits and credits, they subtract or offset each other. So $5,000 minus $750 would be $4,250. The debit was a larger number than the credit. $5,000 is larger than $750. So the difference will end up on the debit side. Okay, then we'll go to the next one. Advertising expense was a debit of $400. So we would find advertising expense. Here it is right here. And that would be a $400 debit transaction, which would also be a $400 debit balance, since there are no other transactions here at this point. And then we would go back up to checking. We would put in the date, the journal reference, and it was $400 on the credit side. To get the ending balance or the running balance, you would take the $4,250 debit minus the $400 credit, and that difference is $3,850. And it would go on the debit side since the debit of $4,250 was larger than the $400 credit. Okay, then the next one is a debit to office supplies for $300 and a credit to checking for $300. Here's office supplies. We would put in the date, the journal reference. It was a $300 debit for the transaction, and then since there is nothing else here, it would also be a $300 debit balance. And then go back up to checking. This was a $300 credit. If we take the $38.50 debit minus the $300 credit, we get a balance of $35.50. And it would go on the debit side because the debit was larger than the credit. And it wouldn't make sense to have a balance over on the credit side of checking because that would mean you had a negative amount of checking as your running balance. So we talked about that a couple videos ago, about how the running balance is naturally going to fall on whatever that increased side is. Okay, the next one is a debit to checking and a credit to revenue. So we would put the date, the journal reference. This was a debit to checking for $1,000. So if we have two debits, we have a $35.50 debit, and then we just added another debit of $1,000. Two debits add together, so that would be $45.50 as the ending or current balance in checking. And then we would find service revenue, put in the date. The journal reference on all of these is J1 because I didn't have separate page numbers. The transaction itself was a $1,000 credit to revenue, and that would also be the ending balance or running balance since there were no other revenue transactions yet. Okay, let's go to the next one. We had a debit to checking of $50 and a credit to office supplies of $50. So let's go back up to checking. We would put the date, the journal reference. It was a $50 debit to checking. There was already $45.50 in the account as a debit balance. We would add the additional $50 debit to get a $4,600 debit balance. Two debits add together. And then we would find office supplies and put that transaction in here. It would be a credit to office supplies. The debit of $300 that was already there as a balance minus a $50 credit would give a $250 debit balance. Remember, debits and credits subtract from each other, and this makes sense. They bought $300 worth of office supplies and they returned $50 of that, so that leaves $250 of supplies remaining. Okay, let's go to the next one. The next one was a debit to accounts receivable and a credit to revenue. Here's accounts receivable. I would put in the date, J1 as the reference, and an $800 debit here under the transactions. And then since there's nothing else, there's zero beginning balance and an $800 debit. The running balance would simply be $800 in the debit column. Then under revenue, I would enter the $800 credit. There was already a $1,000 credit balance before, and now there's an $800 credit transaction. The two credits would add together to give me an $1,800 credit balance. The next one was a debit to insurance expense, credit to checking. So I would find insurance expense, put in the date. The journal reference is just J1. It was this $600 debit. And since there's nothing else here, no beginning balances, no prior transactions, the $600 would also be the debit running balance over here. And then I would put the $600 in checking also. It was a credit to checking. There was already a debit balance of $4,600, and then I would simply subtract the credit because debits and credits subtract from each other, and that would give me a $4,000 difference, and it would go in the debit column since the $4,600 debit was bigger than the $600 credit. Then in the next one, there was a debit to equipment for $3,000. So let me find equipment. I would put in the date and the journal reference, and the $3,000 would go in the first debit column. And since there's no prior balance or prior transactions, that would also be the running balance. Then there was a credit of $1,000 to checking. And I would take the $4,000 debit balance that was already there minus the $1,000 credit from this transaction to give me a $3,000 debit balance. And then there was a credit to accounts payable. Accounts payable had a 0 beginning balance, and I would just add this transaction. It was a $2,000 credit, and since there's no prior transactions or prior balance, the running balance would also be a $2,000 credit. Okay, let's go to the next one. This was a debit to owner draws. The owner took money out of the business, so I would put that in owner draws. There's no prior balances, so the balance would also be a $1,000 debit. And then I would also put that in the checking account. It was a credit to checking. And then we'd go to the next one. Debit to checking for $800. There was already a debit balance of $2,000 plus a debit transaction of $800. You add two debits together to get a $2,800 debit. And then credit accounts receivable. There was an $800 debit balance before this transaction, and then with the $800 credit, the debit and credit are going to subtract from each other to give a 0 balance. And I don't know how to make it show the 0, but this would be a 0 balance. Okay, then the next one was a debit to utilities expense for $230 and a credit to checking. Here's utilities expense. And the transaction itself was a $230 debit. Since there are no other transactions here, no prior balances, I would also carry that $230 over to the debit balance column. And then checking was a $230 credit. There was a $2,800 debit balance before. I would subtract the $230 credit from the debit to get a $2,570 debit balance. And then the next one was a debit to checking and credit to revenue. Under checking, there was a $2,570 debit balance plus $2,100. That would be $4,670 if I added those two debits together. And then I would want to put that in revenue. It was a $2,100 credit to revenue. There was already $1,800 in this account as a credit. Two credits add together. $1,800 plus $2,100 is $3,900 as a credit. And then the next one was a debit to accounts payable, credit to checking. Here is accounts payable. And it was a debit here. There was already a $2,000 credit. 2,000 minus 500 is 1,500. Since the credit was bigger than the debit, 2,000 is bigger than 500, the ending balance will go on the credit side. And then it was also a credit to checking. $46.70 as a debit minus a 500 credit would be $41.70 as a debit. Since the debit of $46.70 was bigger than the credit of 500, the balance goes in the debit column. And then you have the last entry, debit salaries expense for $1,200. The balance section would also be a debit of $1,200. Then debit payroll tax expense for $90. That would go down here. And again, it was just a single entry. There were no prior balances, so I just put the 90 in the debit transaction column, and then it was also the balance. And then there was a credit checking of $1,070. $41.70 minus $1,070 would be $3,100 as a debit, since this debit was bigger than this credit. And then credit payroll liabilities for $220. And since there was a zero prior balance and there were no other transactions, the balance is also $220. And that's it. I posted all the entries. Notice I did not talk about why I was doing a debit or why I was doing a credit. I was simply copying from the journal to the ledger. Now what I would do to check my work is go back and get all of the ending balances and put them into the trial balance. Here's the blank trial balance. I would put the account number, I would put the account name, and then I would put the ending balance and make sure it goes in the correct column. For example, checking had a $3,100 debit balance. And I would just do that for every account. Look to see what the last transaction was and what the balance was after that last transaction. And this is what the completed trial balance would look like. I'm not going to type all of this out, but you can look at this and try this on your own if you would like. And just verify that the total debits do equal the total credits. If they don't balance, then more than likely there's a mathematical error somewhere, or you simply put something on the wrong side. Maybe you put a debit on the credit side or something like that. I hope this video was helpful. If you have any questions, let me know in the comments below, and thank you for watching.